Hello, and welcome to the Bull and Bear Invest channel. This is module 4.1 of our Understanding the Stock Market series, and we're going to be looking into the common trading mistakes made by the majority of traders to try and save you from losing money. Stock trading. We are all in this game for the same reason: to make money. It is estimated that 90% of all traders lose money, and some of the practices that result in losses are easily avoidable with some self-discipline and research. Within this video, we hope to explain some of the main causes of why trades result in losses and what you can do to prevent them happening to you. If you like this video, please don't forget to subscribe and leave a comment below if you would like any aspect of trading on the stock market explained to you in a future video. FOMO trading is one of the biggest causes of losses while stock trading. FOMO is an acronym for the fear of missing out, and it affects a large proportion of traders across the world. There are so many issues caused by FOMO trading. The first is the fact that you just purchase a huge variety of shares on an impulse without performing any research into the company, just because you don't want to risk missing out on this next big thing that everyone's talking about. This has the potential to leave you stuck with your investment in a stock that is not likely to recover anytime soon if the share price devalues. Not only that, because FOMO trading is so apparent and in your face on all social media platforms, I have seen so many people pulling money out of stocks that are performing well to get involved into this next big opportunity. In the examples of which I have witnessed, 9 times out of 10 this next big thing has failed and the share price has taken a rapid decline, leaving them stuck. Whilst the stock that they withdrew money from to fund this new opportunity has absolutely excelled, and they have entirely missed this opportunity. So how do you avoid FOMO trading? FOMO trading is encouraged by online forums and social media. And if you are finding it harder to resist the temptation to buy shares within a company that you have only just learnt the name of and perform no research into potential returns, then disengage from the groups temporarily. Try trading solo, conduct your own research and seeing what you are capable of when you trade solo, without the support of the groups that are encouraging you to purchase shares within companies that you don't know. Reach out to friends who understand the stock market. They are likely to have experienced FOMO themselves. They may offer you some personal advice, or even better, some reliable tips. Emotional trading is a cause of some of the losses incurred from trading. Share price movement is generated based on human emotions. You cannot let your emotions get the better of you. It is easy to become attached to a stock that you have dedicated hours worth of time to research. Even more so when it starts to pay off and the share price increases or decreases depending on how you are trading. But you cannot let this get to you, as it can cost you everything. An increasing share price is enticing, and it can be hard to sell when there is more potential available. You have to remember, what goes up also comes down. You will have to be incredibly lucky to sell at the peak, so don't get greedy and accept your profits whilst you can. You are in a competition with every other trader. Remember that when sales exceed the buys, the share price drops, and you want to be selling before everybody else to maximize your profit. The stock market is unforgiving, and it is a place where you need to be selfish from time to time, and researching the stock should not result in becoming attached to it. Set yourself a profit margin and stick to it. Top slice if you deviate from your plan as a minimum. Make sure you retrieve your original investment, allowing the profits to keep on running if you choose to do so. But set a stop loss, and amend this periodically so you minimize the gap between the share price and the stop loss that is set. Impatient tendencies. Losing value in your holdings can be stressful and upsetting, and make you feel like you're a failure. But this is trading, and this happens to everyone. Just because your holdings value has decreased does not mean you need to sell. In fact, it can mean quite the opposite. By buying in at a lower price than before, you decrease the average price per share, which provides more opportunity for greater profit for when the share price increases again. You must always remember that a share price will move up as well as down. Being patient and refusing to sell when your holdings value is in negative figures will ensure profits are made. This does potentially mean that the money you've invested is untouchable until the share price increases again, which is why it's important for you to diversify your portfolio and not bundle all your assets into one company. The key aspects to remember is you lose all potential of recovering the deficit if you sell your holding. The value may have decreased, but the volume of shares remained the same. It is entirely possible for the share price to recover given time, which will then give you the opportunity to sell at a profit when it does. And finally, some of the best investments have come from those that have been allowed to mature. Sometimes it can be healthy to leave your investments alone for a period of time. One of the most common mistakes in trading is price breakout buys. Everyone loves to see a share price increase, but who more than those holding the shares when the share price is increasing? Often when profit can be visualized, people encourage others to buy in so they can benefit too, all with good intentions. However, by buying in when the share price is increasing so steeply, there is a good chance that what you are seeing is the movement that everyone else has been waiting for. By buying in on the share price increase, you are positioned at a much higher average share value. This value is likely to be the similar or the same value that others will be selling at to make their profit. Remember, when shares are sold, the share price drops. This has the potential to leave you with a bundle of shares that you have lost a percentage of their value, with little scope to recover the deficit and almost zero chance to make any profit. Play it safe. If somebody gives you a tip, give it a few moments. Sit back, think about it, do your research. Does the research tally up? Is there potential for the share price to increase further? If not, let it go. We can't seize every opportunity. What matters is the opportunities we do seize, we make count. There will be more opportunities and you will be able to be part of it. Another common trading mistake is something that I call multi-bagger chasing. A multi-bagger is a term given to a stock that returns several times the value of the original investment. Let me explain a one-bagger. A one-bagger will be a stock that returns your original investment and then the value of your original investment in profit, so your total is twice the value of which you invested. A two-bagger will be the value of your original investment and twice the value of your original investment in profit. In theory, these would be the best stocks to be investing in, and you would be correct. However, in reality, these stocks are rare, and buying in at the right time is even rarer. The chances are, if you're hearing about them, you're already too late to the party. As soon as the stock gains interest, the share price increases with others buying into the once-in-a-lifetime opportunity. This will be heavily publicised on social media platforms and other websites. By conducting your own research and seeking opportunities yourself, you give yourself the advantage of a rock-bottom price, increasing your chances of multi-bagging. Let me explain the concept. If you buy £100 worth of shares at 25p each, the share price reaches 50p, you've doubled your money, creating a one-bagger. If you buy £100 of the same share at 50p each, the share price must reach £1 until you've doubled your money, whereas the purchase at 25p would now be worth £400, returning the original investments and 3 times the value of the original investments as profit, making it a three-bagger. Multi-bagger opportunities will come by, but don't rely on the hype and the attention that the stock is receiving by social media. Be brave and do your own research and let the facts indicate the potential earnings. Don't chase the rumour without substantiating the claim. And don't put your money in chasing another person's dream. After all, that's all it might be. Follow your instinct. If you believe strong enough in a company that you are doing your own research for, then give it a go. You could be onto a winner. But in the meantime, focus your investments on small and steady growth to return a reliable profit over an extended time period. This should help keep your money safer than just gambling it away on multi-bagger chasing. The rushed recovery. Suffering a loss whilst trading is expected from time to time, but if you find yourself in a streak of losses, you cannot rely on chance alone to change your luck. The probability is your method of identifying stocks to invest in needs to be improved. What worked before might not be working now, and occasionally it is time for change. Otherwise, your investment strategy is just simple gambling. Here are a few simple steps you can take to reset your mind and start making some serious placements instead of simply throwing your money at anything you see to recover your losses. Take a step back and stop investing for a short period of time and reconsider your trading strategy. Reach out to a friend who shares an interest in trading and ask for advice. Discuss how they conduct their research and where they look for information. Is it different to yours? And discuss the trading strategy. Without a strategy, nobody's making money. How is theirs different to yours? And what can you take away from it to improve your own? Finally, to summarize, be patient, stay positive, and reap the rewards. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." We wish you the best of luck with all your investments, and subscribe and let us know if you want any aspect of the stock market explained in any future video. Thanks for watching.